What if you could make money while you're sleeping? Not because you found some secret side hustle, not because you're working 16 hours a day, but because you own something that can produce cash even when you're not actively working. That's the difference between earning money and owning assets that can earn money for you. And here's the part most people miss. You don't need to be a millionaire to start. Some of the most powerful money-producing assets can be started with relatively small amounts of money. Others require serious capital, but can create much larger income streams over time. So in this video, I'm going to walk you through 15 assets that can potentially generate income day and night, how they actually make money, what makes them powerful, and which ones may be realistic for someone starting in 2026. And no, this isn't a list of get-rich-quick schemes. These are real assets. Let's get into it. Let's start with one of the simplest. Dividend-paying stocks. When you own shares of a profitable company that pays dividends, you can potentially receive cash simply because you own part of that business. Imagine you invest $10,000 into a portfolio generating an average 3% dividend yield. That would be roughly $300 a year in dividends, before taxes, and assuming the dividend stays unchanged. You didn't have to clock in. You didn't have to answer emails. You simply own the asset. And the really interesting part is that dividends aren't necessarily the only source of return. If the underlying companies grow over time, the value of your investment can potentially grow too. Of course, dividends aren't guaranteed. Companies can reduce or eliminate them, and stock prices can fall. But that's exactly why diversification matters. Instead of trying to find one magical dividend stock, many investors build diversified portfolios designed to produce income while also participating in long-term market growth. Now let's take that idea one step further. You don't necessarily need to pick individual companies. You can own a broad market index fund. Think of an index fund as buying a tiny piece of hundreds or even thousands of companies through one investment. Instead of asking, which company will be the next winner? You're essentially saying, I want to own a piece of the overall market. Some index funds pay dividends, while others focus more on reinvesting income. And there's another powerful concept here: compounding. If your investments generate returns and those returns remain invested, your money can potentially start generating returns on previous returns. That's how relatively small investments can become much larger over long periods. It doesn't feel exciting in year one, but after 10, 20, or 30 years, the math can become very interesting. Now let's move into physical assets. Rental real estate. A rental property can potentially produce income from rent while also building equity over time. For example, imagine you purchase a property and rent it to a tenant. The tenant's rent helps cover expenses such as the mortgage, property taxes, insurance, maintenance, and other costs. If there's money left over after those expenses, that's potentially cash flow. And if the property appreciates over time, you may also build wealth through appreciation. But there's a catch. Real estate is not automatically passive. Tenants can call you. Repairs happen. Vacancies happen. Property taxes change. Insurance costs can rise. And sometimes the numbers simply don't work. So don't buy a rental property just because someone tells you. Real estate always goes up. The real question is, does the property produce attractive returns after all expenses? That's the number that matters. Here's something interesting. What if you like the idea of real estate, but don't want to deal with toilets, tenants, or broken air conditioners? That's where REITs, or real estate investment trusts, come in. REITs allow investors to gain exposure to income-producing real estate without personally owning and managing a property. A REIT might own apartments, warehouses, shopping centers, office buildings, data centers, or other real estate. Investors can potentially receive distributions from the income generated by those properties. And because many REITs trade on stock exchanges, they're generally much easier to buy and sell than an actual building. But again, there's risk. REIT prices can fall. Interest rates can affect them. And different types of real estate behave very differently. So don't treat every REIT like it's the same asset. Now let's talk about something much less exciting, but extremely important. Bonds. When you buy a bond, you're essentially lending money to a government, municipality, or company. In exchange, the borrower generally agrees to pay interest and eventually return the principal, assuming they meet their obligations. Treasury securities are one example. For investors who prioritize income and capital preservation, bonds can play an important role in a diversified portfolio. But here's something people often misunderstand. Bonds are not completely risk-free. Even government bonds can have interest rate risk if you sell before maturity. Corporate bonds can have credit risk, and inflation can reduce the purchasing power of your income. Still, bonds can be useful because they provide a different source of potential returns than stocks. This one is incredibly simple. A high-yield savings account. You're probably not going to become wealthy from one, but it's still an asset that can generate money while your cash is sitting there. Instead of keeping your emergency fund in an account earning almost nothing, a competitive savings account may pay interest. The beauty here is simplicity. There's no landlord, no tenant, no stock picking, no complicated strategy. Your money simply earns interest. And in 2026, with interest rates still an important part of the financial landscape, it's worth comparing the rate you're actually earning on your cash. Just remember, don't chase a slightly higher rate while ignoring safety, fees, withdrawal rules, or whether the institution is FDIC insured. The goal isn't to squeeze every last dollar out of your emergency fund. The goal is to make your cash work without putting your safety net at unnecessary risk. Here's another place people sometimes keep cash: money market funds. These funds typically invest in short-term, relatively liquid debt instruments. They can be useful for investors who want a place for cash that may offer income while remaining relatively accessible. But don't confuse a money market fund with a bank savings account. They're different products. And importantly, money market funds are investments and aren't the same thing as an FDIC-insured bank deposit. Understanding that difference matters. Because when you're dealing with your emergency fund or short-term cash, safety and liquidity can matter more than chasing returns. Now we're getting into an asset with much more upside and much more work. A business. A profitable business can potentially produce cash flow far beyond what a normal savings account can generate. Think about a local service business: landscaping, cleaning, auto detailing, HVAC, plumbing, a digital agency. The business creates a system where customers pay for a product or service. And eventually, the owner can build processes and hire people so the business isn't completely dependent on the owner's time. That's when something interesting happens. You stop owning just a job. You start building an asset. But let's be realistic. Most businesses don't become passive overnight. Building the system can take years. And many businesses fail. So the goal isn't, how can I work less immediately? It's, how can I build something valuable enough that it can eventually operate without me? Now here's an asset that can be incredibly scalable. Digital products. Think ebooks, templates, online courses, design assets, spreadsheets, software tools, educational resources. You can create something once and potentially sell it thousands of times. That's very different from selling your time. If you work 1 hour for $50, you make $50. If you create a digital product for $50 and sell it 1,000 times, the economics are completely different. Of course, getting those 1,000 customers is the hard part. Creating the product is only half the equation. You need distribution, marketing, trust, a real problem to solve, and a product people actually want. But when those pieces work together, digital products can become highly scalable assets. This is the digital version of the same idea, but potentially even more powerful. Software. Imagine building a simple tool that solves a specific problem. Maybe businesses pay $20 per month to use it. If you eventually have 1,000 customers, that's potentially $20,000 in monthly recurring revenue. Obviously, that's revenue, not profit. You still have development costs, customer support, marketing, taxes, payment processing, and other expenses. But software has one incredible characteristic. You can sell the same product repeatedly without physically producing another copy each time. That's why software businesses can become extremely valuable. And with AI development tools becoming more accessible in 2026, building certain software products is becoming easier than it was several years ago. But easier to build doesn't mean easier to sell. The biggest advantage still comes from solving a problem people genuinely care about. Here's an asset that people often underestimate: a YouTube channel. A video you publish today can potentially generate views months or even years from now. And those views can potentially create multiple revenue streams: advertising, sponsorships, affiliate commissions, digital products, memberships, and even customers for another business. That's what makes content interesting. You're not only creating a video, you're creating a piece of digital real estate. One successful video can continue bringing attention to your business long after you publish it. But there's an important difference. A YouTube channel isn't passive at the beginning. You need to research, write, record, edit, publish, improve thumbnails, study analytics, build trust. But over time, your library of content can become an asset that keeps working. The same principle applies to websites. A useful website can attract visitors through search engines, social media, referrals, or direct traffic. And those visitors can potentially generate revenue through advertising, affiliate marketing, subscriptions, or products. Imagine creating a website that answers hundreds of specific questions in a particular niche. Someone searches for one of those questions at 2 a.m. Your website provides the answer. That visitor might click an affiliate link, watch an advertisement, or purchase a product. You might be asleep. The website isn't. That's the basic idea behind an income-producing digital asset. But again, Competition is real. Search algorithms change. AI-generated content has increased dramatically, and low-quality websites can disappear quickly. So the websites that survive tend to provide something genuinely useful. Now here's an asset most people never think about. Intellectual property. A book, a song, a photograph, a design, a patent, a licensed invention. If you own intellectual property and someone pays you for the right to use it, you may receive royalties or licensing income. The incredible part? The work can potentially keep producing income long after the original creation. A book written years ago can still sell today. A piece of music can continue generating royalties. A patent can be licensed to another company. Of course, not every creative work becomes valuable. The challenge is creating something people actually want. But intellectual property can have something physical assets often don't. Global scalability. Let's go back into the physical world. Vending machines. A vending machine is basically a tiny automated retail business. You place it somewhere with consistent foot traffic. People buy products. The machine operates without an employee standing there every second. But don't make the mistake of thinking, buy machine, make money. Location is everything. A machine in a terrible location can make almost nothing. A machine in a high-traffic location can potentially perform much better. Then you have inventory costs, machine maintenance, payment processing, theft, restocking, and location fees. So the asset isn't really the machine. The asset is the system around the machine. And finally, we have an asset that's often ignored. Your skills, your ability to sell, your ability to communicate, your ability to code, your ability to analyze data, your ability to manage people, your ability to create content, your ability to solve expensive problems. Unlike a stock or a property, your skills aren't sitting in a brokerage account, but they can increase your earning power. And higher earning power gives you something incredibly valuable, more capital to buy other assets. Think about the progression. You develop a valuable skill. That skill increases your income. You save the difference. You invest that money into assets. Those assets generate returns. You reinvest the returns. And eventually, your money starts doing more of the heavy lifting. That's the real game. Now, here's the most important thing I want you to understand. You don't need all 15 of these assets. In fact, trying to build all of them at once could be a terrible idea. The goal isn't to collect assets like they're Pokemon. The goal is to build a financial system that works for you. Maybe your first asset is simply an emergency fund. Then you start investing in diversified funds. Later, you buy a rental property. Maybe you build a business. Maybe you create digital products. Maybe you build a YouTube channel. The specific combination depends on your income, risk tolerance, time, knowledge, and goals. And there is one principle that connects almost every asset on this list. Cash flow is powerful, but ownership is the real game. When you work for money, you trade time for income. When you own productive assets, your capital, business, intellectual property, or systems can potentially continue producing value without requiring you to personally work every minute. That's how you begin moving from, I work for money, to, my money works alongside me. And that's a completely different financial mindset. So let's quickly recap the 15 assets. Dividend-paying stocks, broad market index funds, rental real estate, REITs, bonds, high-yield savings accounts, money market funds, small businesses, digital products, software and apps, YouTube channels, revenue-producing websites, intellectual property, vending machines, and finally, your skills and knowledge. None of these are guaranteed money machines. Every investment carries some level of risk, but they all share one important characteristic. They can potentially produce value without requiring you to exchange every dollar for another hour of your life. And that's what makes assets so powerful, because you can only work so many hours in a day. But an asset, if you build it correctly, it can keep working long after you've stopped. If this video helped you understand money and investing in a different way, hit the like button. It really helps the channel. And if you want more practical finance videos that break down how money actually works in the real world, subscribe to the channel and turn on notifications. I'll see you in the next one.